I got one for you. I'll be even shorter. So last year, right, Tesla did this billion-dollar capital raise on the idea that they were going to have 1 million robo-taxis on the road this year, right? So by the end of this year, they should have 1 million robo-taxis. They just rolled out FSD beta. The videos are, I think, in our view, disturbing to say the least. So we now know they're not going to have 1 million robo-taxis, right? Many analysts gave them credit for that, value that. So what do the analysts do? Hey, just create another business they're going to get into.
I think this is a really important example of a much bigger trend that's happening in the stock market, which is that retail investors now have access to so much information that it's almost on parity with people that work in traditional investment organizations. And what we've seen is that's happened is that the quality of that analysis and the ability to see around the corner is as good and in many cases better than traditional investment firms and the way they view the problem. So from day one, you have had this massive tension between the bulls and the bears on this company. And the bulls basically saw a long-term trend around electrification, and the bears tried to play with balance sheet mathematics.
When you say what's the difference, it's literally night and day. What we do now is we do that second type of analysis where, like, if we're looking at a EV company, we look at demand by region. Then we look at demand for that specific brand. Then we model out what their costs are. And then we add all that up to get to a number. We're not backing into, just because a stock has went from 50 to 500, we're not backing into a model that spits out a $500 stock price, right? There's times where stocks are grossly overvalued, which I think now a lot are. So the difference is night and day. And I think the difference is a lot of research shops at bulge brackets and even mid-tier investment banks are really just investment bankers. A lot of the analysts I work for are now literally investment bankers, right? There's supposed to be a Chinese wall, if you will. We don't think it exists. So I think a lot of people are getting false information, which is why you have these valuations that have run to these levels, right? The real reason is the Fed. We can get into that. But these analysts are just supporting ridiculous valuations. I think it's going to come back to bite them, when this Fed bubble pops.
Of course, if I said you can sell 90,000 cars, but then if you negative sell 100,000, you've not sold 10,000. And you would say, what does any of this mean? You can use any convoluted logic to try to be short this stock. And what you would have done is just lost an enormous amount of money.
So I hear you on that. I could have told you what the end of that story was. He's just going to change some other input because, again, you're not really valuing a company. Valuing a company is building out a model, putting a multiple on the earnings, and or discounting the cash flows you think are going to happen, and that's your valuation. What you're doing when you're doing investment banking, as we did in investment banking, is the company tells you what they think it's worth, and then you build your model to back into that value they think they're worth. That's not valuation. That's what you call goal seeking. That's investment banking work. That's not research/stock analysis work, in my view.
And so what we're going to see now is that the stock is going to become part of the S&P 500. It is the leading edge when it comes to electrification and decarbonization. And here's the thing, Andrew, what the bulls will get right and what the bears will ignore from here is that this is no longer about cars. That's the first wave of growth. And I think people are pricing in an evisceration of traditional autos and an enormous shift to EVs, of which Tesla will get the disproportionate share.
But with respect to how it's been, it's been extremely tough. Carson, as you know better than anybody, I feel like, short bias research should actually demand a premium because we're taking a huge risk to voice these views. If you look at the average rating on Wall Street as a percentage, right, at every major firm, Goldman, JP Morgan, Morgan Stanley, all the way down the list to the Jefferies, et cetera, probably have 90 to 95% buys and the rest holds and sells. As you know, not every, that just doesn't fit reality. But the point is, no company is going to give us a marketing day. They don't allow us to ask questions on calls. They don't respond to our calls. You're supposed to have, full and fair disclosure. We are supposed to have the same access to these companies as everyone else, but it's a joke. We don't, and it's just become accepted in the industry that if you have a sell rating on a company, they're not going to talk to you. They're not going to give you access, and that's unfair, and it biases not only the research but the people reading the research to what the management wants to hear. And it's unfortunate because with companies like Tilray, with companies like Tesla, with companies like Jinko Solar, When the reality comes out, these stocks are going to drop and people are going to lose fortunes. It benefits them to hear both sides. But the problem is, on the short side, the bias is so strong that everyone is trying to censor you.
So now what is the bet? If you ask me as an investor who loves that company, it was in page 4 or 5 of their quarterly earnings release where they talk about the energy business. And they said a couple of interesting things. The first is that it was profitable. And the second is that they're also producing software now that allows effectively anybody to become a distributed utility.
All it takes is a change in sentiment. All it takes is for a big investor in some run to say, hold on, you're telling me 20 years down the line, every one of your customers is going to renew their solar contract with you? No way. You know what an earnings driver model is, right? Let's say you have a lemonade company. You have to predict what the demand for lemonade is going to be. You have to predict what the cost for that lemonade is going to be and what the cost for sugar is. You model those out, and that's how you get to your gross margin. You don't just say, hey, revenue is going to grow every year 5%. Costs are going to grow 3%. And you know what I mean? So that's like goal seeking, right? You're backing into a conclusion.
Now think of that for a second. You are talking about one of the most predictable, reasonable businesses that have raised hundreds of billions and trillions of dollars of debt. And what Tesla is going to do with their battery packs and their software is all of a sudden allow each of us to be in the energy business as well. Again, people will get angry. They will not understand. They will try to push back, and they will be wrong.
I said before, I think short research should demand a premium because it's much more risky to put out a sell rating, not just from the perspective of getting access to management, asking questions, etc., but from a legal perspective. And let me explain. So we literally put out a note once. It was a company where the CEO had purchased a couple of shares. It was a 3-sentence note. And it was like, he purchased this amount of shares. This is how much he purchased last time. Here's what the stock did since he purchased. And that note got picked up by the media. And we ended up getting sued, me personally, and my company at the time, which wasn't GLJ Research, got sued. The point is, that was a very long and stressful and tedious and horrible process. When you say the word fraud in a research report, lawyers have told me that could get you back into a situation where a company could potentially sue you for defamation if there isn't real fraud.
And what's going to happen is that this stock is now going to represent the totality around decarbonization and sustainability. So it was really great to own this thing around cars for the first 4 years. I did it. I made a lot of money. But now I underwrite this company as a bet towards decarbonization, towards deregulated energy, and towards the ability for all of us to become our little micro utilities.
Is it batteries? Are they going to sell drivetrains? Are they going to be utility company? Like you got guys going on CNBC saying Tesla's not a car company, it's an energy company.
And here's the thing, Andrew, what the bulls will get right and what the bears will ignore from here is that this is no longer about cars. That's the first wave of growth. And I think people are pricing in an evisceration of traditional autos and an enormous shift to EVs, of which Tesla will get the disproportionate.
It's literally crazy what's going on right now if you have any perspective of how truly to value companies and if you have perspective on companies that have did similar things before. So